Today wasn't just another red day for technology stocks. Something changed. For the past year, investors have been asking one question: how big can the AI opportunity become? Today, Wall Street started asking a different question: can all of this AI spending actually generate returns that justify today's stock prices? And that question triggered one of the biggest sell-offs we've seen in AI and semiconductor stocks in weeks. Let's break down exactly what happened. The major indexes all finished lower. The Nasdaq Composite fell more than 2%. The S&P 500 dropped roughly 1.4%. The Dow Jones Industrial Average was relatively resilient, finishing only modestly lower. At one point during trading, the Nasdaq 100 was on pace to lose more than $1 trillion in market value, while approximately $776 billion was erased from the broader Nasdaq Composite. That is an enormous amount of wealth destruction in a single session. But the real story wasn't the indexes, it was semiconductors. The Philadelphia Semiconductor Index, or SOX, plunged approximately 7.6%. And here's something you may not have heard elsewhere: every single stock in the semiconductor index traded lower today. That's unusual. This wasn't one company missing earnings. This wasn't one piece of bad news. This was broad-based selling across the entire AI infrastructure trade. Let's look at the biggest losers. Some of the biggest losers included Micron Technology, down roughly 11%, SanDisk, down approximately 12.6%, and AMD, down around 6%. NVIDIA, down nearly 4%, Tesla, down roughly 5% to 6%. Amazon and Alphabet also finished sharply lower. When an entire industry sells off at once, it usually means investors are reducing exposure to an entire theme. There were three major concerns driving today's selling. First, interest rates. Markets have increasingly assigned higher odds to another Federal Reserve rate increase by September. Why does that matter? Because higher interest rates put pressure on growth stocks. AI companies command premium valuations. Second, the cost of building AI. Technology companies are committing hundreds of billions toward data centers and manufacturing. The question is whether these investments can eventually generate returns large enough to justify today's spending levels. The market isn't questioning whether AI is real. The market is questioning whether expectations have moved ahead of economic reality. Third, the trade became too crowded. For more than a year, investors poured money into a small group of AI stocks. Crowded trades can reverse quickly. When everyone owns the same stocks, even small shifts in sentiment can trigger large moves. While technology was getting hit, money quietly rotated elsewhere. Healthcare, utilities, and consumer staples held up better. Investors move into those sectors when they're looking for more predictable earnings and lower valuation risk. And here's the most important takeaway. Everyone talks about NVIDIA, but right now, the company that may matter most is Micron Technology. Because memory demand is difficult to fake. Companies only buy massive amounts of memory when they are actually deploying AI infrastructure. The AI trade hasn't collapsed, but it may be entering a new, more selective phase. The question is no longer who is involved. The question now is, who can turn unprecedented AI spending into sustainable earnings and real shareholder returns? Today's sell-off suggests that Answer may determine the market's next winners. Tomorrow, all eyes turn to Micron. I'm Nicholas Thomas. This report is for informational purposes only and does not constitute financial advice.